welcome back everybody from the tea break. We're going to resume our conversations right now, and we'll be directing all of the, I guess, after the coffee break, our energies into the last two segments, which will focus on investment strategies. And on this panel, we have the company of Anita Krishnamurthy. She's CEO, CIO, Brands Investment Partners Asia. We have Alvin Chow, CEO of Dr. Wealth, and we have Robin Yeo, CIO of Maybank Asset Management. Moderating this segment is Thilen Vikramasinghe, Maybank Singapore's Head of Research. Thilen, may I please invite you and the panelists onto the stage, please? Thank you.
Good afternoon, everyone, and thank you, Seng Yao, for that introduction. Let's get some energy back in after the coffee break. Some of the most used words since the beginning of the 2020s are words like unprecedented, historical, new normal, record-breaking. I'm sure you can think of a few yourself, but 2023 is turning out to be no different. Markets are behaving in ways that are defying forecasts. The US is facing the most forecasted recession of all time, but the economy is humming away. The initial euphoria of China reopening seems to have turned out to be a little bit disappointing. Southeast Asia was supposed to be the star of the show this year with flows coming in from North Asian geopolitics, and the results there has also been fairly mixed. So how do we make sense of it all? How do we make profitable investment decisions, or at least protect our downside risks in times like this? I can't think of a better panel than Anita, Alvin, and Robin to discuss this. Despite their youthful appearance, they've got multiple decades of investment experience, managing money through multiple cycles and advising investors. So I'm looking forward to deep diving this afternoon. So Anita, let's start with you. There's a war in Europe. The relationship between the world's two largest economies, the US and China, is on razor's edge. Interest rates and inflation are at record highs in decades. Yet the S&P and the European markets are up double digits year to date. You've lived through a few market cycles in the past couple of decades. So how do you characterize this one?
Instead of turning it on. Thank you, Thilen, and thanks Maybank for having us all here. What you said about being youthful is an interesting point. And I think what we also need to understand today is that the allocators of capital today are increasingly youthful, more so than the three of us here. And what is also interesting for us is at Brandis, we like to say history repeats, but it never rhymes. So there's a little bit of lessons learned. We've been in high interest, high inflation environments before. If we think about the 40s and the 70s and the 80s, we've all been there before, or at least we can pick up a book and read about it. And what's happening today is slightly different for a couple of reasons. One is we've come off a decade of low interest rates, and that has really changed the way we consume and the way businesses build their balance sheets. Secondly, we have a very nice, but obviously tumultuous confluence of various things happening at the same time. So we've got the inflation, the rates, we've got geopolitics, we have changes in government going on in the US, as well as other regimes. And so I can't actually answer your question very neatly in that we can't characterize it. And I think that is key in that investors, like all of ourselves, we need to be nimble and we need to be diversified. And that for us was the key lesson at Branders as we sort of look back on our portfolios and how we constructed it, thinking about what we thought would happen 5 years ago and looking forward to what we are seeing today. There's too much information, a lot of data, and if you want to put the data in a package that makes your case, you can. On any given day, you could say the Feds are going to keep the rates high, or you could say they're going to lower it. And so I think as you know, a careful, rational sort of custodian or guardian of capital, you got to just think about how you want to diversify your portfolio, how you're not overexposed, and then how you want to build that and stay invested, you know, over the next couple of years.
Thank you, Anita. I also want to get Alvin's perspective here as well. I mean, you've also been writing about these markets for a very, very long time. So how do you kind of characterize the current markets?
Maybe I played a little bit of like a devil's advocate, right? Since a lot of investors believe that this rally is not sustainable in the US. I think some of the things don't look that bad. Of course, there are always two sides of the coin, whether you want to focus on the negative part or the positive part. So probably I talk a little bit more about the positive part. And one thing that I see is when we talk about even the war in Europe, it's pretty much contained. And NATO didn't get involved directly. They didn't go and support Ukraine by sending in forces to fight, but they did send in a lot of supplies to help Ukraine. So I think they are rational in the sense that they know that they don't want it to blow up to a bigger scale, a bigger level. So I think in that sense, that part is contained. And when it comes to inflation rate, it didn't cross that 10% mark like what they did in the 70s. So it climbed to about 9+% in June last year, and it started to fall all the way to 4% last month. So in a sense that it didn't, inflation rate didn't like sustain at a very high level, above that 10% level for a long time. So which means that the rate hikes have been working so far. And right now we are even talking about pausing the interest rate, and probably we are definitely closer to the peak interest rate than where we were last year. And I think that with this new clarity or visibility of where the peak interest rate is, does give investors more confidence that it might be a case where it's time to load out some of the more familiar names, the mega cap stocks, and that's why I think that caused that rally to happen.
Thanks, Alvin. You know, Anita brought out a very interesting point about a lot of asset allocators today, you know, being fairly youthful. So, you know, I want to speak to Robin directly here. You know, many millennials came of age when it comes to investing post the global financial crisis, where interest rates were low, inflation was persistently low. So this is the world that they have known for most of their investing life. Cost of risk for them was negligible. So in the current environment, where you know, what are some of the key considerations investors should actually pay more attention to when they are constructing their portfolios, Robin?
Thanks, Dylan. And thank you for inviting me again. I also participated last year. So really for millennials, I think the short is the era of free money is over, right? And I guess investors really need to look at cash flows of companies. So as Anita pointed out, a lot of asset allocators haven't seen rates at 5%. You know, they've probably joined after the GFC. But what you've seen is rates have gone up sharply. And although the US stock markets are doing well, what you notice is that the unprofitable tech companies are still way off the highs, right? They haven't recovered because cash flows are not there. The only companies which are doing well is, you know, stuff like Apple, the mega caps, which do have cash flows. The other thing you look at is, if you look at crypto, right, they don't have associated cash flows. The best one, of course, is Bitcoin. They've done better, but the rest have really down 60%, 70% from the peaks. So I think looking ahead and bearing in mind that interest rates are going to stay a little bit higher than before, you have to look at cash flows. And the other thing investors would need to look at is also on the leverage. So if you are invested in a leverage product, I guess you want to kick the tires a little, because if you are invested in a highly leveraged product, then there may be problems, whether it is in private equity, whether it is in real estate, right? In the past, of course, you know, you could easily lever up 70%, 80% LTV. But now with rates so high, it's increasingly difficult for people. So millennials, I think, will really have to look at cash flows and fundamentals in the next 5 to 10 years. Yeah.
So cash, that's the main focus. Alvin, you made a very interesting point about inflation. It didn't really hit the 10% sort of mark. It's peaked, but it seems like all you need to do is look around Singapore or most East Asian countries or the US. It seems very, very sticky. Central banks have been using language that point to higher for longer rates, yet the markets are actually discounting rate cuts towards the end of the year. So who's right?
I believe that the market is forward-looking and it will price in a lot of the Fed's sentiments. And the thing is that the Federal Reserve is quite good at preparing the market. They always signal what they are likely to do in the next meeting. And we saw that in the June pause of the rate hike, it was already so-called communicated subtly in his speeches and way before that. So the media and even investors have already sort of like expected that rate pause is going to happen in June. And after the FOMC meeting that's just happened the last few weeks, there was another signal, which is that the rate hikes may continue. So prior to the FOMC, what happened was that the market, which is based on the futures that predict on the Fed fund rate based on the year end, is going to have a rate cut. That was prior to the FOMC meeting in June. Thereafter, because of that statement, the futures market changed again, and it is likely that in July, the 0.25% hike is going to happen. And it's going to stay that way until the end of the year. So which means that even the futures market have adapted and adjusted that a rate cut is not likely this year. So it's going to be staying probably around 5.25 to 5.5% for the rest of the year. Until maybe after the July FOMC, we look at the Federal Reserve statement again to get some indication for the next meeting. So
Right.
as of now, I think that's where we stand, 5.25 to 5.5.
Right, so higher for longer, definitely. And Anita, I want to bring you in here. And with inflation still being a very primary concern for a lot of investors, how can you hedge against that? Is that something that you can do when you're looking at your own portfolios? Are there any practical steps that investors can take?
Yeah, so for us at Branders, and I think this probably applies to most of us in this room, you got to think about the businesses that you own and the underlying businesses. So besides the basics of obviously, having some fixed income exposure, which is a nice way nowadays, and now you get paid for it. On the equity side, you've got to think about whether the businesses and the underlying businesses are able to pass on inflation. So are you on the right side of inflation is basically the question you want to ask yourself. And are the businesses ones that have pricing power? And large, by and large, you want businesses with a moat and a pricing power that allows them to be resilient. And going back to the idea that Robin sort of mentioned, keep generating those cash flows. So, I would say just keep it simple. You've got your fixed income exposures that'll give you some neat inflation hedge. The key, again, and I said this before, is it's important through these cycles to stay invested. There's so much data about how when you get out and in and out and in, the frictional cost of that is extremely high over time. And so staying invested and keeping an eye on what you actually own and the underlying assets is probably the simple answer to that.
Right, so cash and moats and stay invested. That's actually a very good segue to my next question. That's also for Anita and also for Robin. So how are you actually approaching your portfolios in the current environment? Are you actually keeping more cash, or are you actually starting to increase investment weightings? Maybe we start with Robin.
Right, to just give the audience some context, we do primarily Asian investing, right? So we are not a global investor. So really to give some context, we started the year quite positive on North Asia. And that's because they underperformed quite a lot last year, right? Stuff like Korea, Taiwan, and China. whereas ASEAN did well last year. So we were more invested in North Asia. But what happened, of course, is actually led by the US, Taiwan and Korea has done well. So we started taking weights off, raising cash to be more defensive. And as Dylan said, we were kind of positioning for a more defensive period because we are thinking also in the second half there would be a US recession, the most well-flagged recession ever. So we've increased cash. More recently, because valuations have started looking cheap in ASEAN, they've underperformed. We've allocated some weights to countries like India and Indonesia because we think even with a US recession, these countries are a little bit more insulated, more domestic driven. So stuff like Indonesia, India, I think will hold up quite well in a US recession.
Right. Anita, what do you think?
We've largely stayed invested, except we've used, I would say, from the COVID volatility onwards, as well as Russia, and then the more recent volatility, we've used periods of volatility to trade up the quality spectrum. Brand is, so if I speak for myself, we are value investors. We're looking to buy great businesses at either reasonable costs or fair businesses at really bargain prices. And so I'm looking for a margin of safety. We're trying to buy businesses at a 20, 30% discount. And we're long-term shareholders, so we tend to hold it for 5 years. So our horizon is quite different. And because of that particular approach to investing, what we've been able to do through COVID is really trade up the quality spectrum. Our cyclical ideas did very well, so we kind of moved on from that into more defensive or cash yielding names. But we've stayed invested, and unfortunately, we don't have the advantage of holding a lot of cash. People don't pay asset managers to hold cash. So that's just the reality of our business. And so, that's a function of what we do.
Right. Thanks, Anita. So, throughout today, walking the floors and, speaking to a lot of investors, one of the questions that a lot of people kept asking me is, where is this US recession? Where is it, right? So, and, you look at the S&P, it's up 15% year to date. The underlying economic numbers are still humming quite nicely. So, Anita, I'm going to stay with you on this. Why do you think there's this huge divergence between the expectations versus performance?
I think one is we have to think about the amount of flows that now lie in passive investing. The ETFs are now driving most of the market movements, and I think that actually has changed how stocks move. And it's very different from 15, 20 years ago when we had a lot more active investors in the market. So you've got to factor in the fact that there's a lot of passive money, and that kind of is rather momentum-led in general, meaning if something does better, then tomorrow it's going to do even better. And it unwinds as quickly as well. So there's that factor. The other part is, I think if we can all be candid in the room, and there's a lot of data, and it is very difficult to create, a singular theme that is emerging from all this data as to the directional, sort of real GDP growth, sustainable interest rates, and sustainable inflation rates for a longer period of time, more than 6 months. And that in the end results in what I believe is a lot of anchoring. So as investors, we are all human beings. If we hope the Fed is going to, slow down on the rate hikes and in fact reduce it, you see that happening in the markets, in the futures market. And there's a real will of the market trying to win over, regulatory bodies.
Yeah.
And that to me, personally, and again I say this is me speaking, and not on behalf of all the various different types of investors that we have here in the room. It's just a difficult game to beat, and so we at Brandis, and personally myself, we try not to spend too much time trying to predict what is going to happen and why it is happening, but rather try and think about, again, just building that portfolio that is going to generate alpha for you over 3 years. And when you have a long enough time frame, you can skip some of this noise along the way.
I think that's a very interesting point that you make. When it's all about timing, time framing as well. So you can actually skip over the noise. That's very interesting. So Robin, I want to stay with the U.S. market. We've just kind of narrowly avoided, the U.S. debt ceiling, issues. But this is just the latest in terms of U.S. policy uncertainty. We've got a presidential election coming up next year. So how should investors really think about the US market and this increasing political volatility within the US economy?
Well, I think if you look at US politics, it's very polarized. So as an Asian investor, we've got to bear that in mind. And as the elections come closer, American nationalism will be on the rise. And that usually means China bashing, right? And that's a reality. So for investors who are investing this part of the world or even in anywhere else, I would say maybe the focus should be on more domestic-oriented stocks, right? Decently cash generating domestic, because even if you get sanctioned and such, you'll be less exposed to that sort of external risk, whether you're in Korea, China, or even Europe, right? Because even the CHIPS Act actually affected Europe. So really, global investors need to keep in mind what's happening in the US.
No, that's a good point. I just want to remind the audience, there's a QR code behind your name tag, so you can scan that and you can pose some questions for the audience. I'll take those questions right towards the end. Alvin, you've written a lot about this. If you look at pretty much most of this year's S&P re-rating, it's really been dominated by a few mega cap stocks, right? Everything else, not so much. So how do you, what do you think that's kind of, what do you think is driving that? And also, if this recession finally starts to come through, how do you think that's going to impact some of these stocks?
So I think, first of all, based on the studies that I've seen, is that the recession and stock market performance have almost close to zero correlation. So it might come to a surprise to some investors. Historically, when a recession has been officially announced, about half of the time the market is down, about half of the time the market is up. So the correlation is almost zero. So it doesn't mean that when a recession is coming, the stock market is going to do bad. I see that as, in a sense, again, the markets are forward-looking. And in a case, it could have already priced in the recession last year because the markets have gone down quite substantially last year. And especially all the loss-making stocks, they were really taken a very heavy beating, down like 70%, 90% from the highs and has not recovered. So that part of that recession risk probably might be priced in already. And that's why we see that this year's US market has started to recover. So that's one possibility. And if we dive deeper into how this index has been running, is generally driven by the AI team, right? Artificial intelligence, which I think a lot of people have read in the news. NVIDIA, after they announced a record profit for that quarter, as well as the orders that's coming in, it led all the AI-related stocks, whether is it chips manufacturer like TSMC, whether is it other competitors like AMD, can be even software companies like Palantir, they have all gone up together. And I think the rally is mainly driven by this AI theme. And I also personally believe that there is some degree of hype that's involved that is propelling this further than what people think is sensible. So whether it can sustain or not is questionable, right? It might always have some legs to go, but definitely I think there's some hype that needs to be dissipated away. And that, in the second half, maybe if it goes away, we might really see the true strength of where that stock market recovery is in the US.
And artificial intelligence is a topic I want to come back to with you guys a little bit later on. But I want to move on to China. We've got industrial production, profits, property sales, credit growth, you look at whatever the metrics have all fallen short of expectations despite having this COVID reopening. Also, the initial sort of bout of optimism seems to have faded with both the CSI 300, the Hang Seng really haven't done much so far. So how do you think about China's recovery going forward? Is it just a timing thing? And if you look at the past cycles, are there any specific areas that you think can positively or negatively surprise?
Right, Thielen, I guess a lot of it is, Professor Tan actually covered that in the previous talk. I think it's, if you, what I can add to what Professor Tan said is that if you look at China, it's actually a two-tier economy. So after the reopening, services have done really well. So the ISM services is still way above 55. So that reflects a healthy economy in China. So stuff like F&B, traveling, people are back. Where it's not so good is actually manufacturing. And why is this so? Yes, it's true, as Professor Tan pointed out, sentiment is still weak in consumers, so they're not buying big ticket items, like cars, houses and such. The other issue, of course, for manufacturing is obviously China is the factory of the world, right? So maybe about 30-40% of the manufacturing capacity is directed towards exports. And obviously global growth isn't that strong, whether it's in the EU or the US. Although US is not in recession, the growth there is still weak. So as a result, in the manufacturing side, we are seeing struggles. And if you look at China, I think that's the issue, right? That's been an imbalance, and it's unavoidable, I guess, because China has been the factory of the world for many years, and if you don't see strong growth elsewhere, it's come back to bite China in a way. But if you look at services, it's still doing quite well. Now, I think back to your other question on, past cycles, I think it's quite difficult to associate past cycles with this cycle because things have changed tremendously in China, right? In the past, whenever property goes down, then they say, okay, we need to stabilize, then, we'll boost property again. But as Prof said, property isn't coming back because they want property to be affordable. They don't want a property bubble, so it's not going to come back like normal. But how you would see China is you look where they are looking at, right? Where the government wants to focus on, and I think the focus will be on hardware tech. So that's where the invest is going in. And the other thing again is they would have to boost domestic consumption to make up for the loss of exports, right, in the coming years. And that's what even the Western experts say, they need to boost domestic consumption. So in this cycle, I would also still look at, domestic consumption for China. I mean, look at the domestic consumption plays in China. So that's my thoughts on China.
Right. So hardware, tech, as well as domestic consumption, and we're probably looking at a cycle that is a bit more prolonged. That we are.
Yeah, I mean, there's the other thing you pointed on. What's positive and negative. So I think maybe I'm a contrarian here, but I think for some positive surprise, it could actually come from the Chinese internet platforms because expectations are really low for those companies. And actually in the first quarter, almost all the platform companies, whether it's Alibaba, Baidu, they had very, very strong earnings. So for them, if they even show 10% revenue growth, bottom line grows 20-30%, I think that would be a pleasant surprise for a lot of people. In terms of negative surprises, I would say, maybe some of the manufacturing like exports, chips and directed towards outside, that could see a disappointment. Yeah.
Okay, thanks, Robin, for that. Anita, we're talking about very large markets, and another large market that's been getting a lot of attention, especially this year, has been India. It's become the most populous nation on earth. There is expectation that India's growth could overtake China going forward, but the market valuations aren't particularly cheap. So I know you look for value, but at the same time, what are you thinking about India now? I know, looking at the past, India's had quite a few false starts before as well. So is it different this time, or should we really start getting excited?
I've always thought India is an exciting story. Unfortunately for India, I guess it's always been shadowed by the China story. So if you kind of think back, several years ago, you constantly had the picture of China and India, and on The Economist and the FT, who's going to win. But India has been quietly growing and chugging along quite nicely, and certainly stayed a much more open economy than China did. And so it makes a lot of sense that it is on a growth trajectory that will be slightly different, and will perhaps overtake China. The politics and the regimes are quite different, and that's one of the challenges of India. It's an extremely democratic country, as we all know. And whereas China does have the advantage of being able to push through policies, overnight changes of rules, very quickly and effectively, and that's a challenge, and yet an advantage for that country, right? Challenge for investors like us. We don't know what happens, tomorrow, day after, next week. But for China as a whole, if they put their mind to it and they have a plan, they can execute it much faster. For us value investors, again, we love the companies we see in India, but it's always been very expensive on a relative basis. We're constantly looking, and if there are opportunities to participate, which there are every now and then, there's a disappointment, or there's when before Modi came in, there was periods in which there were depressed valuations. Indian stocks can be quite attractive from a valuation perspective, but right now I think what's baked in is a lot of this growth and positivity, but more importantly, this idea that India is going to win over China. And I think the two economies on their own can do very well on their own. They're huge populations. They actually don't need anybody else to do well. And I think, again, from our perspective, we're stock pickers. We're looking at it one by one. We love the companies we see in India. We love the companies we see in China. It's about what risks are you buying, and what kind of cash flows are you buying. So I'm not sure if India is different, but I do think they have come a long way in terms of infrastructure spend, and sort of getting people banked, and just the idea of inclusivity, and then incomes rising. So there is a good story to tell. And I think, again, it goes down to what are you looking at, and can you pick out the winners amongst the big sectors.
So there is something to get excited about. So that's good. My next question is Robin. Alvin, I know you're taking a little bit of a break, but don't worry, I'm going to make you work. So, but Robin, another blast from the past in a way is Japan. Japan's back in business after 30 years. What do you think are the factors that are driving this, and how durable do you think this current sort of trajectory is?
Maybe just let's touch on the factors. I wouldn't call myself a Japanese expert, but if you look at the factors driving the resurgence of Japan, is of course valuations. They've come down from a bubble about 20, 30 years ago where valuations were crazy, 30, 40 times, and now they're in their teens, which is not much different from the US or even Europe. And that's one thing. The second thing is, over the many years, corporate governance, the company's balance sheets have improved. So in the past, Japanese companies hardly paid out any dividends, and now, a lot of their companies have cashed up. Cash is a major portion of their market cap, and they do pay out dividends now, right? So there's been a little bit of change. And I think for the short-term catalyst this year and last year, the major thing going for Japan has been the transition from deflation to inflation, right? And I think the earlier panel pointed out they are the only country which has not increased interest rates, right? Even though inflation is going up. And that has resulted in a sharp depreciation in the Japanese yen. And of course, Japanese companies, a lot of them exporters, and they benefited the likes of Honda, Toyota, and all the trading companies. And recently, of course, there's been news that Warren Buffett is buying into all these Japanese companies. So all these factors have resulted in a strong market for Japan. Whether it's durable, I think for the short term, I think it's probably overdone because in very, very short term, it's gone up so much. But longer term, I still think it's all right because valuations haven't reached anywhere near a bubble. And if you look at some of these Japanese companies, again, there is some value with some of these companies having a lot of cash on their balance sheets.
Right. Thanks, Robin. Alvin, I want to kind of bring you here, and I think we need to, we are Invest ASEAN, so I want to talk a little bit about ASEAN at this stage. But if you look at most of the ASEAN markets, they've kind of traded sideways most of this year, and this is despite this expectation of border reopenings, north-south supply chain movements, policy reforms, and so on. Why do you think this is the case where, the star of the show this year hasn't really performed? And what do you think needs to change to increase the relevance of this region?
I think because ASEAN is tightly linked to China's economy, because China is the largest trading partner of ASEAN. So if we look at China has some sputtering growth reopening since the start of this year, so that would also affect how other investors look at ASEAN. And we did see some of the, especially when we talk about domestic stocks, some of the electronics manufacturers, like Venture, Nanofilm, they did suffer that drop in terms of fundamentals as well as their share price, right? Because it's in relation to how well China is doing. So in order for ASEAN to improve, the China narrative have to improve. But unfortunately, the West control that narrative, which is affecting how the world and investors view China. The fundamentals, if you really dig about it, it may not be as bad as what the media portray it to be, but because the West is very good at this media game, and I think they are really winning it, and that's why I think China or even ASEAN need to do better storytelling. I think that is the only way to really get out of this, because otherwise, in terms of fundamentals, I don't think there is a very bad part of it, right? Because you look at, just now Robin talked about a lot of cash generating companies. Asia or ASEAN are full of these companies. They are not as impacted as the US in terms of inflation. And I think that is where the storytelling needs to come out. The perception needs to change in order for ASEAN valuation to improve. Otherwise, Asian stocks will always price at a discount to the US counterparts.
Right. So ASEAN really needs to do a better job of commanding the narrative. Yeah. Okay. That makes a lot of sense. We are down to the last few minutes, but I can't not talk about AI a little bit. And Alvin's kind of given some of his views, but Anita, I want to kind of bring you here. We've got so much exuberance on AI. I mean, Nvidia, when they gave their first quarter guidance, they added like the market cap of Bank of America in like one trading session. What are your views of navigating this excitement? I mean, is this similar to the hypes that we saw with crypto and fintech and plant-based foods and all the other stuff that we went through? Is this one of those, or is this different?
I think with AI, as with all the other trends that you just talked about, it's just important to think about how you want to play them, and personally feel like there are many ways to play these themes. Nvidia is obviously the daily talked about name in AI, but in terms of valuations, it's gone up exponentially, and it's very hard to justify that kind of growth that would justify paying multiples for it. But there are other ways to play that same theme, and Samsung and Hynix, in our opinion, are sort of the unloved, not talked about at all, trading at less than 10 times earnings, but you still sort of get the broad exposure to the theme. So these are all themes that are probably very much here to stay and will be part of our investment playbook. But being mindful of, which part of the spectrum do you have to play the leader in the market and pay 50 times earnings for it? Can you play the same theme with a diversified player and get it for far less? Hyundai is another example. It's not a Tesla, but they've done wonderfully well with their EV sales in the US markets. And together with Kia, they have 14% market share, and it's a Korean company. So immediately there is a massive discount. And some of it is warranted, but we feel there are just different ways to play these themes and get into fintech and AI and electric vehicles. But the investing environment is broad and diverse, and I would just caution that we don't always have to read the newspaper and buy the most often talked about name. In fact, you almost know that you shouldn't. and it just takes a little bit of work to try and find the second derivative, which could be a far more alpha generating journey.
Thank you. Thanks for that, Anita. Well, we are just about a minute to go, and this kind of brings me to one of my favorite segments of this panel, because it helps with my PA as well. So I'm going to ask each of the panelists, what are your 2 conviction stock picks or sector picks for the next 12 months, and with a quick blurb on why. So we'll start with Robin over there.
Yeah, I remember Thilan did this last year. So I was trying to remember what the picks I did last year to see whether I got it right. So last year, I think I talked about SD engineering, and well, it didn't go down much, it didn't go up much. So I think it's a pass for me. So this year, my advice, if you want my advice is I would pick a company in Thailand doing metal stamping for autos, right? This company called Apico High Tech. Why? Very value. I think Brandis would like that. 6 times PE, dividend paying. They have orders from Ford, Isuzu, and such. So that's one value play. And I think the other one I like, not in ASEAN, I still like Pinduoduo in China. I mean, the platform company, people don't like China now, but it's growing at, revenue was like 50% in the first quarter. Profits were growing, doubling, and not trading at expensive valuations. And if you look at the platform, they are probably, in a way, the value platform in China, so they could continue doing that.
Anita?
So I'm going to disappoint everybody because I'm not allowed to talk about stock picks. And my compliance in the US, I'm sure, can somehow hear me. But in general, we're very constructive US financials. It's a sector that nobody likes, especially after Silicon Valley Bank and the drama that ensued. But we really like how they're sort of hedged against inflation. They're nicely exposed to what is now a higher rate environment. We still see some upside on the NIMs as it kind of cycles through the loan book. And in general, if you kind of stick to the larger money center banks who have been big beneficiaries of deposit flow in the last couple of months, just massive beneficiaries. We just think that that could be a nice place to be, fairly defensive in terms of your diversified portfolio.
Great, thanks, Anita. And Alvin?
I was asked the same question last year, and I remember I chose Media, which is the Chinese aircon manufacturer, as well as Fuzhou Yuan, which was a funeral company in China as well. So like Robin, both are flat from last year. But with dividends, maybe it's about up 3% of total returns. And I think they are still at the same price point, but their fundamentals have grown in terms of revenue, profitability. So they're actually worth more compared to last year. So it still can be looked at. But this year, I'm going to go back closer to home. And let's talk about Singapore stocks. And I think that one of the key themes is I believe that the interest rate, we are close to the interest rate peak. And that generally is good news for REITs, real estate investment trusts, right? Because they were very hit by the rate hikes last year. And it's also quite an unloved investment currently. Not a lot of people are talking about it as compared to, say, many years ago, where REITs were doing very well in a low interest rate environment. So I think it's a good time to revisit them. And 2 particular REITs that I'll be talking about, the first one will be Keppel DC REIT, which is a data center REIT. And we all know that we are moving a digital economy, and data center is like the new growth area for real estates. And that's where I think the DPU growth would continue. They have been having a good track record, and even with the rate hikes, they could increase the DPU in the first quarter this year. So I think they are on track, and they do have more than half of the properties in Singapore, data centers in Singapore. And Singapore is a land scarce place. It's not easy to get approval to build another data center. So I think Capital DC is in a good place. And the other one is also related to data center, which is Maple Tree Industrial Trust, which have more than half of the property portfolio in data centers and the other half in industrial properties. So it can give a bit more diversification if people don't want a 100% data center REIT. And in general, they also have exhibited the DPU growth, and even the recent bankruptcy of one of the tenants did not really adversely affect them because they do have over 2,000 tenants. So that really diversified the risk away for REITs like Maple Tree Industrial Trust. So these two are my picks. And in terms of valuation, just ending off, they are based on their 5 years price to book trading range. They are about slightly below their -1 standard deviation for an average price to book. So to me, that is cheap enough for high quality REITs like these two data centers.
Thanks, Alvin. So, Apico High Tech, Pinto Auto, US Financials with a focus on the larger money center banks, Keppel DC REIT, and Maple Industrial Trust. I hope you took some notes down there. With that, we are really out of time. I want to thank my panelists, Robin, Anita, and Alvin, for joining us today, and thank you, everyone.
Okay, a big thank you to Nita, Alvin, Robin, Dylan, and for your sharing. And truly, the list of recommendations will go down very well in our portfolios.